The CNBC app. Global market news in one place. Customizable sections and personalized alerts. Stocks tracking, interactive charts and market insights all in your hands. Stay connected. Stay informed. Download the CNBC app today.
Hello and welcome to Squawk Box. Here are your headlines today. To the markets, and the Dow posts its best week of the year, climbing for the 8th straight session as attention turns to this week's all-important inflation print. Fresh data paints a mixed picture of the world's second largest economy. Consumer inflation picks up, but credit demand shrinks for the first time since 2017.
The Russian President Vladimir Putin launching a surprise cabinet reshuffle, ousting Sergei Shoigu as defense minister and installing a civilian economist in his place. And Israel ordered more residents to evacuate from Rafah as the death toll in Gaza tops 35,000. US Secretary of State Antony Blinken says Washington needs more clarity on Israel's strategy.
We also haven't seen a plan for what happens the day after this war in Gaza ends. Because right now, the trajectory that Israel is on is, even if it goes in and takes heavy action in Rafah, there will still be thousands of armed Hamas left.
And let's take a look at those US stock markets over the course of the Friday trade and for last week. You could see Friday delivering us a flat picture for the Nasdaq, so running out of steam for that tech end of the market, but still more in the trade for the Dow. That was the 8th positive session in a row and the best trading week for the Dow so far this year. You can see up 1/3% for the session, but over the course of the trading week, just over 2%. Slim gains, but keep in mind we are only less than 1% off a record high. So at this higher benchmark, we're seeing slower percentage increases, but it's been a steady rise for the likes of the Dow. Elsewhere, and perhaps what you're seeing in terms of leadership, utilities up about 4% odd. That was one of the best areas of the market over the course of the trading week. But technology running out a little bit of steam, and you can see it across even in the percentage gains for the FANG Plus stocks over the trading week, up less than 0.5%. Hard to imagine after what we've seen in recent years that the gains on the market this time around coming without that leadership from the tech sector, that it's been breadth elsewhere, the likes of the Dow and some other sectors that has done the heavy lifting over the past week or so. So that's the unusual part about this market. Even if you look at the banks, up about 2% for the trading week, so not quite the high water mark that utilities set for the trade. In terms of what we saw elsewhere, let's just take a look at the bond markets. A little bit of movement at the short end over the trading week at the 2-year readjustment again as the market reassesses when we may see that first interest rate cut. So on bond markets, we saw a slight increase, roughly about 7 basis points for the trading week on the 2-year, 4.86 where we approached this morning. Not too much movement at the long end, the 10-year just off 4.5%. Let's move on to the dollar trade. As a result, we are firmer on sterling and euro this morning, both leaning positive. We're 125.23 on sterling, euro dollar fighting it out 107.69. Dollar yen rates, more support again for the greenback here, which has seen a bit of a decline in yen in this session. 155.79 is what we're watching, but more hawkish comments coming through from the Japanese at this stage. The Bank of Japan sent another signal to markets by making an unannounced cut to the amount of JGBs it's offered to buy in a regular purchase operation. Many see this in line with the hawkish statements we've seen of late from the central bank out of Japan. Elsewhere, dollar yuan is trading higher. The Asian markets response today to the data points out of China. We've had the consumer prices increased for a third month, but further declines in producer prices. So again, question marks around the deflation story and where we're at for the Chinese market, which is slipping today in contrast to Hong Kong that is moving into the green. 120 plus points to the upside, bookend by some slightly modest downbeat action out of the Japanese stock market in retreat today, and Australia down 0.2%. Steve.
Very good morning. How are you?
Thank you.
Did you have a lovely weekend?
I did. The sunshine was glorious, wasn't it?
It was fantastic.
And we had a little bit of Eurovision, didn't we?
Yeah, that was hard to watch.
A lot of politics this time around, as we'd expect.
I don't mind that. That's to be expected. But the
It was
actual
more interesting with all the geopolitics happening.
I do. Yeah, no, that was interesting. But I just thought the actual songs. I mean, I don't want to be that old man. I like pop music. I like a lot of. I'm a big Dua Lipa fan. But oh my God, it was rubbish, wasn't it? I mean, did you hear one song that you could actually listen to again?
I thought they were pretty average, but for me, it was the politics that was so fascinating.
It was like, who can be the most kind of outrageous and yet dull at the same time?
Yeah, but the pivot towards a neutral country like Switzerland at this stage, given everything we're seeing, I thought that was fairly dramatic. Do you think
people voted on because of the neutrality of Switzerland rather than because of the quality of the songs?
Yes.
Wow.
Absolutely.
All right, okay.
Well, you couldn't vote for the quality of the songs, as you're pointing out.
No, it was a struggle, wasn't it? It was a struggle. I'm big fan of Europe. What's that other group called? ABBA? They did quite well, didn't they?
Yes.
Do you know,
Back in the day.
Do you know my stat? Actually, we haven't done this. We should move on a second. Do you know the most successful artist ever out of Eurovision?
You know I'm going to flunk this.
We've done it on air before, you should remember. It's not ABBA.
No.
In front of it is, wait for it, drum roll, Celine Dion.
Really?
Yes, I think she represented Switzerland. I know she's Canadian now, but I think she represented Switzerland, funnily enough. And she is the most successful selling artist ever post-Eurovision.
I was talking to Lisa in Makeup earlier, and we were saying that she was pointing out to me it's the high emotion earlier that is what can carry you across the line, or something completely offbeat, which of course we saw a little bit more of the offbeat.
Better get back on track, actually. US consumer, thank you for that. US consumer sentiment slipped to a 6-month low in May, coming in below expectations at 67.4. Short-term inflation expectations also ticked up, with US consumers expecting prices to rise at an annual rate of 3.5% over the next year, the highest level in 6 months. It's a really important week, actually, of data. Inflation data, I think it dominates this week's agenda. Numbers out from Germany, the Eurozone, and of course the US. Core CPI is forecast to rise by 3.6% in America, which would be the smallest annual increase in 3 years. On the earnings front, Japan's SoftBank. Big numbers out later this morning. We'll get Arjun to speak about this, followed by German heavyweights Bayer and Siemens later in the week. Chinese internet giants Alibaba, Tencent and JD.com also reporting. Now, ahead of this week's key US inflation data, Minneapolis Fed President Neil Kashkari and the Chicago Fed President Austin Goolsbee diverged on whether policy is restrictive enough.
Why does the Fed keep saying that financial conditions are tight? They're not tight. We think that monetary policy in part works through financial conditions. And if the business community does not feel like financial conditions are tight, that makes me question maybe we're not as restrictive as we would have guessed.
Right. On the question of are we restrictive, the Fed doesn't really control long rates. There's a lot that goes into longer rates. So I tend to look at the Fed funds rate minus inflation, the real Fed funds rate. And to me, the level of that is as high as it's been in some time. Right. So I feel like we're in a restriction.
Let's get to Steve Englander, who is head of global G10 FX research and North America macro strategy, Standard Chartered Bank. Steve, great to see you. Let me pick up on what we're going to see out of inflation, because there's still been a lot of reporting around the housing component that is not coming down as much as many had expected, which is still putting some heat into the core component of inflation. What are your expectations here? Do you think we are going to see housing start to fall back in line anytime soon?
Well, the answer is yes. We should be seeing it to fall back soon. The question is whether it's this week. There's a very good index that's put out that basically looks at what the CPI should be doing based on lags of what new tenants have been paying in terms of rent. And that's been coming down very sharply. The issue is that that's a quarterly index, right? And CPI is a monthly number. So our regressions tell us that rent, owner equivalent rent should be coming down in Q2, but it can't tell us whether it will come down in April, May, or June in Q2. It just tells us that it should be sliding.
Steve, I was reading an interesting report, which was in the Wall Street Journal, and was saying that, look, not every component has to be 2%. Just a reminder, as we talk about the target, that individual parts had previously actually been higher than that. And as we talk about housing getting back to target from 5.8 to even 3.5%, heavy lifting still required. But the non-housing services inflation data also somewhat key, and that needs to get down from about 3.5% now to about 3%. Is there any suggestion, as we look at car insurance prices, all those elements and services that have been driving up that basket, that they are also starting to flip?
Not really. We don't get that much information on those core services in advance of CPI, so it's a little bit hard to, make a forecast. We do see, bits and pieces. We see car prices, goods prices looking very weak. The Adobe Digital Price Index, which is goods entirely, came in very weak. But that services component is sort of a black box until it gets released. I mean, the issue, and you correctly alluded to insurance, I mean, it tends to be very inertial. If it's going down, it keeps going down. If it's going up, it keeps going up. It doesn't bounce up, down, up, down, up, down. So we have to see if that upward trend is beginning to abate.
Steve, really nice to see you today. I love the fact that we're all data-driven in this new era. I personally was always data-driven, but one piece of data which you may or may not care about is the Atlanta Fed nowcast. And I think it's very interesting. It's like a running estimate for our viewers of where they think GDP possibly is at the moment. It is as hot can be. The latest estimate, which came out just a couple of days ago, is 4.2% GDP growth at the moment. And beneath that as well, real private domestic growth increased somewhere in the region, I think it was like 6.8%. Regardless of inflation being stuck at, I don't know, even if it goes down to 2.9%, the fact of the matter is, with GDP growth in somewhere in the region of 4%, you can't cut rates, can you?
Well, you couldn't if everything was telling you that it was going at 4%, and everything is not. I mean, we have consumer surveys which are very weak. We had the business surveys also looking very weak. And let me say this, GDP is probably the worst number that the market pays attention to. I think that there are a lot of indications that the economy is slowing gradually. Not in recession and nowhere close to recession, but kind of at the low end of normal or the top end of soft. We'll just have to see how it plays out. I mean, look, you can have a right forecast and you can have a wrong forecast. I've had plenty of wrong forecasts, and GDP now is no different.
Yeah. But why is the stock market completely wrong then, Steve? Because Karen just mentioned the Dow having its best week of the year. S&P companies are thrashing expectations, and we're trading near to record levels on a lot of these markets. The stock market's completely wrong then, yeah? It just needs to be more tempered.
Well, they put it this way: if we are getting a big number on GDP, say output is really growing fast, the employment growth is not growing nearly as fast. It would mean that we're getting a lot from productivity, which tends to push profits up. So it's possible that that's kind of what the market is looking at, that it doesn't matter if the economy is slowing, if margins are rising, and if forward-looking margins are rising. But again, it's not something to mortgage the house on. It's a broad tendency that you observe over long periods.
While we have you, can I ask you about the dollar strength still at this point? Because the Japanese had to be more aggressive at this stage, trying to tame some of the depreciation in the yen. Other currencies continue to depreciate too. What do you make of the strength we're seeing in greenback at this point?
Well, it's kind of what you get. I mean, we're at 2 cuts this year, and we're kind of among more kind of optimistic on how much the Fed is going to cut. And everybody else is going to cut more. That's usually the driver of dollar strength. And we expect dollar strength broadly to continue. We expect the euro to, go below 105 by the end of the year. They're determined to cut, and the Fed isn't sure it's going to cut and how much it's going to cut. And that's still the story that's out there, and that the market's waiting to see how it plays out.
Steve, thank you so much for joining us today. Steve England with us, head of Global G10 FX Research and North America Macro Strategy, Standard Chartered Bank. Coming up on the show, the curious case of the Chinese consumer. We'll talk through the inflation outlook and domestic demand picture. Plus, fast fashion company Shein reportedly steps up plans for a London listing and what would be a major boost to the bourse. And earnings season continues. We'll get a pulse check on the banking sector with the CEO of Alimity Bank, Corrado Pesera. That exclusive interview is coming up at 8:30 CET.
ambition to me is about doing better.
I think ambition creates a pathway.
The best advice I can give to someone starting off a career is don't have a career, have lots of careers, try loads of different things.
Talk to people and put your ambition out there.
I don't feel that I've hit peak ambition because it's a learning journey.
CNBC is where ambition meets opportunity. What does living ambitiously mean to you? Hear it from our CNBC anchors, reporters, and global business leaders on CNBC.com.
Fashion giant Shein is pushing ahead with plans to list in London, according to sources that spoke to Reuters. The Chinese-founded group continues to face obstacles with its preferred option of a US IPO coming under increased scrutiny from regulators. The report suggests Shein will update Chinese securities regulator on its IPO location and could file with the London Stock Exchange as soon as this month. US President Joe Biden is reportedly set to hike tariffs on Chinese electric vehicles and increase levies on other key industries, including semiconductors and solar equipment this week. That's according to multiple reports. The total tariff on Chinese EVs will reportedly jump to more than 100% from 27.5% currently. The head of Volkswagen has warned Brussels against raising tariffs on Chinese electric vehicles. The VW brand chief Thomas Schaefer has said that such a move would risk retaliation against international brands operating in China.
Yeah, he's right, but it doesn't seem to worry Joe Biden this week, and we'll come to that one later on. Chinese consumer inflation rose for a third straight month in April as policy support boosts demand. Consumer prices edged up by 0.3% from a year earlier versus a rise of 0.1% in March. Producer prices continued to decline. Sam, how significant is this? I'm sorry, more importantly, Sam, good morning to you. How are you? How significant is this?
I'm very well, Steve. Thank you very much. Good morning to you guys as well. This is a sign of stabilization, no doubt. This is the third month we've seen so far of these consumer prices picking up. The outlook now is that they should stay positive, but although mild for the next few months, no doubt helped by the summer period. Of course, we'll have holidays, high pork prices, which do make up for a big chunk of that consumer basket. Also, the favorable low base effects. But we're speaking to economists today who suggest it's very difficult. Certainly at a headline, it looks encouraging, but to decipher whether the price pressures and some of the deflationary pressures have gone away and whether this really is demand driven. And that's because part of this story is that we have seen actually over the last few months, China increasing the prices of things like utilities and transport. So that no doubt is sort of demand restraining, as they've called it. So it'll be very interesting to see over the next few months whether some of those pressures actually smooth out, particularly given that we do continue to have these challenges with the labour market. We saw that in the latest PMI survey as well. Certainly the picture looks better when you look at some of the manufacturing and services PMI performances at these companies. The jobs market still remains a concern here, and so that is impacting long-term income expectations. So that is something that is very challenging right now, not to mention the property sector as well. So the PBOC very much still has its work cut out for it, no doubt, and that's why last week it was sort of reiterating its supportive stance, very much focusing on FX stability as well. But getting back to the data, the core still ticking up as well, 0.7%. So that's when you strip out that volatile food and energy. So that does show signs of recovery and stabilization as well. The PPI, it's a 19th month of deflation now, so continuing that trend we've seen for over a year and a half. This continues to be down to the sort of weak overseas and domestic demand picture, not to mention the property sector as well. So that is likely to continue, although that deflation did come off a bit. But then we also got, which sort of goes hand in hand with what it's telling us about the demand story over in China right now, with the credit and the loan data out over the weekend as well. So overall, new loans actually came in less than expected for the month of April. The household, mostly mortgages, those loans, that borrowing was still contracting in April, and the corporate loans still grew, but definitely softened up. And we do tend to see this actually coming off a bit in April because they do tend to front load in Q1 to attract those sort of higher quality customers. But certainly TSF seems to be the big one that everybody's looking out for at the moment in terms of some of the notes out from the banks, the analysts, what they're talking about today, because that actually hit a record low in terms of those TSF flows. And so very much it looks like the PBOC needs to continue this supportive stance. Very much seems to be expectations in the market now of a triple R cut at some stage in Q2 and then subsequently some interest rate cuts certainly down the road. But there certainly seems to be a concern right now about more credit going into sort of the manufacturing side more so than in the consumer's pockets, and that very much exacerbating the problem in terms of those deflationary expectations down the road and perhaps limiting some of the other tools that they have in the box over at the PBOC as well. Back to you guys.
Sam, thank you very much indeed for that on the inflation data and the consumer as well. The big announcement this week, interestingly, Karen had a read about Volkswagen and how their brand chief said, look, just don't impose tariffs on Chinese products. It's going to hurt us in China. Joe Biden doesn't seem to be worried about that. A huge amount of fresh tariffs on batteries, EVs, solar cells as well. This could be a huge event potentially for trans-Pacific relations. Just how is it being read in China, do you think?
Well, the big question is, Steve, how is China going to respond? Now, the Foreign Ministry responded pretty swiftly as expected on Friday, saying that it will protect its interests, no doubt. We've already started to see a response by the Chinese EV makers who are already sort of preempting this kind of pressure, circumventing, looking at third countries like Mexico. We know that BYD is already there, so sort of finding a back door here. So it's going to be very interesting to see the contours of this announcement when Biden actually comes out with this week, which is being reported, as to whether they're actually going to be trying to plug some of those loopholes. That seems to be certainly the big concern. The other way that China could potentially respond to this is by hitting agriculture products. Once again, we saw that in the Trump trade war, going after things like rare earths. We know that that's popped up as a way that China could have leverage, certainly in this dispute as well. But we've got to remember that China, this is nothing new in terms of its industrial policies. I mean, the first impression of what we're seeing from the Biden administration is that this very much strikes at the heart of some of those, the green energy transition, and now President Xi Jinping's new campaign about new productive forces. But these campaigns have long had a name for decades. Made in China 2025, and now they're looking to replace American technology with domestic alternatives that also has a Chinese name by 2027. So now that these have sort of caught up, people are talking about an overcapacity problem. We've heard that from the likes of Janet Yellen. China doesn't see that it has as an overcapacity problem at the moment, but it's going to be very interesting to see how effective some of these tariffs will be when you already have a 25% tariff on Chinese EVs. So not many of them actually make their way onto the American market anyway. So you're talking about quadrupling that 100%. No doubt the expectation is that would force a lot of these Chinese companies to third countries. And then you've got the solar equipment, for instance, as well. Well, we know that solar panels, for instance, are already being made here in Southeast Asia to try to circumvent some of that pressure and those duties too. So I suppose we'll have to wait to see what the announcement will be and what they're actually targeting and whether they will actually try to plug some of those loopholes in third markets. Guys, back to you.
Superb coverage on both stories. Thank you very much indeed for that, Sam. Zika surged in its New York debut on Friday, giving the firm a fully diluted valuation of $6.8 billion. We did talk about this valuation quite a bit on the show on Friday. The company's CFO gave CNBC his thoughts on competition in the sector.
If you look at the big picture, you know, the market over there is very, very crowded. But if you zoom in a little bit and you look at each of market brackets, price brackets, you know, there's definitely an opening in the premium market segment. Say, for example, Zeekr, we've been selling, you know, cars mostly priced between RMB 300K to 500K. So we've been competing with the likes of Mercedes, Audi.
Thank you for listening to Squawk Box Europe Express.
For more market-moving news, you can head to CNBC.com or join us again on the show with me, Steve Sedgwick, and Karen Cho, weekdays on CNBC.